Hey guys, David Robinson here. Welcome to the Lead Sponsor Podcast. We've got another great episode for you today. Today, I'm talking with Vehano Joseph of DreamstoneInvest.com. Vehano is the chief executive officer and co-founder of Dreamstone. They've got a growing multifamily investment firm based out of Atlanta, Nashville, and Tampa MSAs. And they have 2,100 units under management, totaling 320 million in value. The vast majority of that portfolio is solely owned, or at least they own and operate those units. 270 million of the 320 is managed through acquisition, and then they do third-party management for the remainder. Again, 2,100 units over the last 5 years. They've got 7 employees at the corporate level and 27 total across the other businesses, including the property management business. And today we talk with Vehano about his background in mergers and acquisition and a financial background, and how he decided after his career in that space to really make a big transition and burn the bridges and go into the real estate world, and how he started out with buying a simple duplex and then growing that to 14 units, then 26 units, then going even larger into a larger commercial multifamily. And ultimately what he focuses on today, which he focuses on in the last 2 years, mainly A-class, newer construction, value add, core plus assets. And in the Sun Belt markets, again, in the Atlanta, Nashville, Tampa MSAs, down in Texas as well. We talk about a 294 unit core A-class new construction value add deal that he bought for 63 million. He just closed on it in the last few weeks. He raised $21 million of equity. The assets base is located in Richland, Texas. And so we talk about that particular acquisition. We talk about how he structured the equity, how he structured the debt, and what he saw as sort of the business plan for that particular asset. And then lastly, we talk about his predictions for the real estate market over the next 12 months and what he would do if he were starting over today, if he had to go down to zero, how he would grow his business. So had a great conversation with Vehano today, and I hope that you enjoy the interview. So without further ado, Vehano Joseph. All right, Vehano Joseph, welcome to the Lead Sponsor Podcast. Thanks for coming on and spending some time with us today.
Thank you for having me.
So why don't we kick things off? If you don't mind, tell us about your business as it is today. What do you guys do? How is your business structured? Where are you based out of? What have you accomplished thus far there at Dreamstone?
Yeah, so Dreamstone is headquartered here in Atlanta. We're a vertically integrated firm. We hold roughly about 2,100 units under our management, combined just over $320 million worth of assets, including the third-party management that we do on behalf of other clients. I'm a bit of a serial entrepreneur, so we also have other businesses that we own within the group of companies. So we truly are a private equity business, and yeah, love it. We've been in existence for about 5 years now, and yeah, it's been an awesome ride.
Great. And how is your business structured? Are there other principals involved in your business, employees? Obviously on the property, if you've got the property management side and other companies that are sort of under the umbrella company here, you probably have a lot of employees. But at the more of the private equity level, what does that business look like?
Yeah, so at the I call it the holding company, the corporate. We're a team of about 7 folks. Globally, we're about 27 employees and heads. And so we're structured with myself and my business partner, Nick Contesso, who's my COO, and we have another a couple of partners that are, non-founding partners, but have really shown their value over the years. And so I have a head of acquisitions and then also head of investor relations. So we have, you know, different heads in that group.
Yeah, understood. And you have 2,100 units under management, roughly 320 million. You have the property management arm. How much of that portfolio is acquisitions and how much of that is management?
Acquisitions about 270 million and property management's about 85 million.
Okay. So the vast majority of your portfolio is stuff that you guys own and operate yourself.
We started in-house and then acquired a property management company, which specialized in single family, and then brought in a director, and then we have a president of property management who handles multifamily and single family arms. So we can handle both verticals within one company. So that's kind of my thought process around that. Management is key to executing our business plan. You can't have success without execution. So, the vision of and the budgets and all of these things, so can't happen without the teams on the ground. So you better make sure you have the right people executing the day-to-day tasks. So that's how we achieve that.
Understood. Well, thanks for giving us an overview of your business as it is today. Let's back up and let's talk about how you got to where you're at today. Maybe give us some background about yourself, professionally, what you've done in the past, and how you got involved in the real estate private equity space.
Yeah, so I'm originally from Cape Town, South Africa. I'm a chartered accountant by trade, which is a CPA equivalent here in the US. I came to the US with Grant Thornton and worked with them internationally for 7 years. Started down in Fort Lauderdale, Miami area, and then transitioned into management finance consulting, where I did projects for Wells Fargo, business banking, commercial real estate, light tech, asset-based lending. We owned, coast to coast, and did projects for Silicon Valley Bank. Did a $3 billion acquisition for Johnson & Johnson in Tampa, and then I was the director of acquisitions for a private equity-backed OBGYN company that was buying up mom and pop practices across the country, which is quite a hoot. And then kind of ended my my consulting and fast-paced living in the more traditional accounting space, where I was the corporate controller of WestRock, which is a $19 billion company in Atlanta, one of some of the largest paper mills out there. An interesting company. It was just way too slow for me, coming from consulting and dealing with issues and in and out, and that excitement. So, it just wasn't a good fit. And I decided, look, got to burn the bridge. I'm going full time into real estate. And at that time, we started with a duplex and 7-unit, 14-unit, and 56-unit. Now we're at 21. So, that's kind of been the journey. The thing that sparked it for me, and I think as a real estate investor, I think all of us always kind of love to hear what kind of got you to real estate. I think reading Rich Dad Poor Dad, listening to podcasts, listening about the real reason why I got into it is we used to have these sessions when I was a consultant from the CEO group, and so the CEO would make us do every quarter. We would spend a Saturday every quarter, doing some sort of event or get together with our local offices. But before, your pre-work would always be your balance sheet, your income statement, and your list of goals, spiritually, physically, emotionally, family, and you'd have to map out those goals. So every 90 days, it's kind of a strategic coach practice. You're filling out this form, and I looked at it and I was like, man, I'm never going to get to this big number doing what I'm doing. And I ended up, looking at real estate, and it kind of made sense. And being a student, a lifetime student, I just dug into it and started reading and listening to podcasts and meeting people and reaching up and reaching out to people is very important. And there's such a, at least in the multifamily space, you find some really great mentors and people willing to help you. And so it's kind of how I got there. I also have to credit my wife. Uh, she was my girlfriend at the time. We had been looking at buying a house, and I was really looking at buying a convertible because I had a trade in the motorcycle, and so I was looking for a little fun little toy, and so credit to my wife now, and we went and we bought the duplex, and
Uh,
we really 4x that investment. So
I
yeah, it was
bet.
good.
I bet that was the catalyst for you moving into the real estate space. I'm curious though, with a background in mergers and acquisitions and more on the financial side of things, um, did you consider, and granted, there's an argument to be made that all of these real estate deals are small businesses that you're buying. That being
100%.
said, it's different than buying a, a, a a real business without a better way of explaining it. Did you consider going that path with your background in mergers and acquisitions and financial background of just buying businesses and building businesses versus going the real estate path? Or was it always just sort of naturally, hey, we're going to go down this real estate path. We're going to start with a duplex and grow from there?
That's a really funny question. But yes, so coming from the mergers and acquisition side, I didn't know that you could buy businesses. I always thought, coming from that, it's always the massive company acquires, some other massive company. I've only been exposed to that kind of industry. So especially working for public companies, so we never really delved into the kind of middle to lower markets of business. So I think just for the lack of knowing, I moved into real estate and identified it as a business. It is a business. There's
Mm-hmm.
income, there's expenses, and there's EBITDA. And so, you value by EBITDA or NOI, it's the same thing. And so you're doing the same thing, is whether it's a 7 multiple or cap rate. So treating it as a business, it came quite natural to me. And obviously having done that in my previous career, made that aspect of dealing with lawyers, dealing with the deal room, underwriting, making sure the financial performers line up, making sure that there's risk scenarios and different kinds of metrics taken from those models and applied to those models. So yeah, we we did during COVID. I did, however, learn from my business partner that you could buy these little mom and pop businesses, and I frankly think there's a wonderful opportunity out there for people that are looking to accelerate their financial freedom, or I don't know, it can be a trap, so buying another business, it's risky. It's there's definite risk associated with it, but just like a multifamily or single family, you've got to mitigate that with the mitigating factors. So we acquired 3 businesses during COVID when everything kind of slowed down. So we looked at, okay, what can we do to put our own equity to work to generate cash? And so, we bought a few companies, and that, yeah, I don't think that'll stop.
Yeah. Well, maybe as time allows, we'll dive into those businesses a bit, but
Yeah,
I want to talk about the growth trajectory, right? You've been at this for roughly 5 years, starting with a duplex, and now you've got, a portfolio of, 270 million that you've acquired on your own, and then, 320 million total. I mean,
yeah.
that's significant growth in a 5-year period. What has enabled you to grow at that pace?
Just an incredible team, incredible, um, strict underwriting, and just yeah, just really great mentors and team members that have stuck with me and stuck with Dreamstone. You know, it's afforded us to acquire these great assets, you know, and partner up with other folks. That you know, the multifamily spaces is you know, as you know, it takes a team to get these deals done. It's not
Yeah.
when you're starting out. It's you know, you can maybe do these small ones, but you run out of talent pretty quickly. So you've got to have your components kind of set out. You know, acquisition, asset management, property management, disposition. Make sure you have all those uh, key processes taken care of. And if you don't, find somebody that has that capability.
Yeah. And, you know, as we have an opportunity to interview a lot of different sponsors, everybody's path looks a little bit different. Some get into the space and they immediately target, you know, B class or A class, 300 unit apartment buildings, in, you know, high growth markets. You've acquired, I believe, if I got the numbers correct today, roughly 27 total deals totaling 390, well, 270 million. So give us, so that isn't your tip, that isn't the, hey, let's go, you know, take down, you know, a handful of $50 million deals. That's starting, and I love hearing the story about this growth trajectory, you know, starting small, building upon what you have acquired, selling or repositioning the equity to help grow. Tell us a little bit about that process for you and what you focused on from an asset type perspective.
Yeah, and I think you get your stripes from doing, from executing and learning. And you know, the best way I could see our growth and you know, was starting small, building up the confidence. You know, going back, looking back at my younger self, you know, 5 years ago, you know, I think this was the right path. Could it be more aggressive? I wish, but you know, we learned some things. We got our, you know, we got our slaps on the butt. Just like any other investor that comes on here, they've had their not so great moments in their deal, and it's just life, right? So it's and business. So you have a myriad of things that can go wrong, and you know, you always make sure that you're buying these properties right so that you can weather any kind of situation. And COVID was a hell of an eye opener to us, and you know, we kind of love the stress. We love that you know, kind of um, opportunity when everyone else is on the sideline, because that just opens up deals. And so you know, for us, you know, middle market guys, it's really been great to even see us do deals in this environment, which has been really challenging. But at the same time, I look back to COVID, you know, 2020, we did, you know, 5, 6 acquisitions, and for us that was really, um, you know, great when you know how that was, you know, credit at that point. But you know, we've shifted from the traditional workforce housing C class, older property, heavy lifts. Unless it's a killer steal of a deal, we'll do a C class, you know, or a heavy renovation. We just haven't seen anything that made sense. And we've looked at you know, where it makes sense to put our capital, and I think that's organically pushed us into A class,
Mm.
kind of tertiary A class properties, and so that's what we've been focused on for the last 2 years. Really focused on the larger 250 unit plus A class properties, because you know, there's protection in those larger deals.
Mm.
So uh, we've been focused on that type of asset type, and so we've done that in San Antonio. You know, we bought a 340 unit at 202 a door. You know, well below replacement cost if we had to start it today. And you know, doing the same thing in Richmond, Texas, 215 a door. You know, if I had to build the same apartment today, it'd be 250, 260. So
So
that's the kind of
be
opportunities we're focused on right now.
Yeah, and so you've started to look at those type of opportunities within the last 2 years. Prior to that, what was your typical investment criteria? What were you looking for in a deal?
Yeah, so we were looking at upper teens IRR returns for our investors. We're looking, we were acquiring things at like 65, 55 a door.
So you started buying the newer assets in the last 2 years, larger, newer assets in the last 2 years. Prior to that, how would you describe your investment criteria? What were you looking for in a deal from an asset type perspective?
Yeah, so asset type, we were looking at, your typical C-class property. We're focused on heavy value add, something where we can return a increase in rent at least at, $150, $200 per unit. The typical starting point of anybody's career, which, I see it makes a lot of sense for a reason that there is safety in that. So I don't you know down discounted, but it's just become so expensive in the last couple of years that we're looking at where else would I put my capital where there's not a credit risk.
Mm,
So right now, I never used to think like that in the past, but when we started renovating and increasing rents, there's a kind of a ceiling where these properties get to, and so for like Tampa, for example, Tampa's a great market. It's expanding and growing, but some of the deals you can only raise rent so much, and
hmm
and it also becomes a social thing. Like yes, you're improving the unit, and you're doing the renovations and you're providing a quality service, but at the same time, what are you doing to that community? You're outpricing a lot of those lower income folks that are living kind of paycheck to paycheck, and when you start to get to like four times people's income, then it becomes an issue where you really start to worry. But that wasn't the general Tampa. We also had properties, A-class properties, where it was we'd raise the rent from 1,500 to 2,100 and no one
mm.
batted an eye, right? But really quality A-class stuff, right? So I guess it all depends on the asset type, and kind of if you're buying it at the right basis.
Yeah, makes sense. So you've had the opportunity to acquire, heavier lift C-class deals, and you've now had the opportunity to buy larger, I'm assuming lighter value add deals, A-class deals. What would you say from an operations perspective are the biggest challenges for each asset type?
Yeah, so right now in the value add space, execution risk is huge, right? So supply chain disruption, labor disruption, depending on where you are, is huge. So in Atlanta, people are spoiled for choice. So it's hard to keep good people because they're always being poached. But maybe in markets like Texas, maybe not so hard because there's such an influx of people. So that really helps that stabilize that labor side of things. So for the value add space, yeah, supply chain, making sure you get your right materials. That I can tell you how many times we've had to find an alternative,
Mm-hmm.
right, in the last couple of years, which is kind of a pain, which is really pushing us more towards newer class because time kills everything. So time kills all deals, and so renovations is a key part of that business plan. If you're not executing that, then obviously you better make sure you're well reserved and all that good stuff. And then on the newer stuff, not to say that it's light work. It's still you still have to asset manage to the same criteria because um, your value add there is, well, at least for us, how we buy properties, we're looking at new properties that have gone through lease up, or the majority of the lease up where that developer is leasing it up at a lower rate than market, just to get people in. So we're, looking for that next turn. So, providing service, making sure the amenities are there, making sure that, it's more of a service delivery quality type operational team that you need to have. So making sure we're efficient and professional really drives that higher, uh, rent that we get on renewal.
Yeah. So on the C-class stuff, it's really execution on the timeline of the rehabbing or the capital improvements. And on the A-class, it's really more focused on the operational improvements. Is that correct?
Correct. That's at least how we're,
Your
driving our
model.
business models. Yeah.
Yeah.
And so we'll see some, we'll see lease trade outs. And for one example, we're seeing lease trade outs, $250, $300 from where they were renting during COVID. And now it's coming, those first rents are coming due, or first turns coming due. And it's incredible. Like my capex into that project is, 250 bucks for cleaning, and I've got such a lost lease to capture, because that's just really where the market's pushed to. Now, is that going to be forever? I don't think so. I think we've got a bit of a unicorn pocket of the market right now. So does it last forever? I don't know, but we're going to capitalize on it.
And we're recording here mid-November. Obviously, there's some turbulence in the market today. What are the biggest challenges that you're seeing across your portfolio? If you were to identify the top one or two challenges that you're addressing and working to overcome across your entire portfolio, what would it be?
Yeah, so there's two. So one is maintaining occupancy, right? That's number one, always 100% our focus. So always weighing up the cost between uh, you know renewing that person or getting somebody out. This top part of the year, we're all about renewing, making sure that relationship's good, because December's so slow. You really don't want to be leasing up, and unless it's a brand new property and you're doing that. But existing portfolio, we're focused on fostering those relationships, making sure that the teams on the ground are keeping everybody happy, and getting us closed out for the year at a nice high occupancy. And then from our I guess from our acquisition side, the credit market is definitely challenging, and it's challenging to navigate right now. But we're finding some creative solutions to get around some of these things. So yeah.
When you say creative solutions, what do you mean?
Yeah, so the bridge market's kind of propped up our real estate market for the longest time now, and everyone's moving towards the fixed rate products, and so we're finding some really good lenders that are coming up with really good products that are fixing rates, or some lenders are still bridge lenders, but they have a synthetic bridge where the product's fixed, but it's still floating, which I thought
Mm.
was quite great for this market, because the deals are going to get done, but you need to it's a bit of a reset now in pricing and terms.
And finding those creative solutions or those lenders that are willing to be creative, has that been an intentional strategy and effort by you to reach out and seek out those lenders? Or has it sort of happened naturally just by being in the industry, having a property management company? Have those lenders sort of been finding you? Or has there been any tactical, strategic efforts made to go out and seek those opportunities that maybe some of our listeners could learn from?
Yeah, I'm all about putting my ear to the ground and hearing what's coming, right? And kind of just getting a pulse of the kind of the nation. A lot of my relationships are in New York, and so there's a lot of capital moving there. I consider that where the most of the big deals are put together, and across the nation. So my I spend a lot of time actually with my broker, having just updated calls. Hey, what's going on? Where's the market at? Where's Fannie? Where's Freddie? And touching base just to get a pulse of like what's out there. And sometimes we're underwriting a deal, and I'm like, hey, so this is what I'm trying to achieve. What do you guys have as a solution? What have seen come through? And so having a great broker always helps with that.
Yeah. And would you say that the majority of your debt is sourced through the broker, or are you making any intentional effort to reach out to other debt options?
Right now, it's we have relationships with lenders that we've closed with and have done deals with and gone full cycle, and so we always hit up our usual kind of suspects. But I like to have a broker involved because you never know, like these synthetic bridges or things like that that come up that are just like, oh, I didn't know that these things existed, or fixed rate bridge products that, yeah, I didn't know that these existed, but they do. So,
Give us
there's definitely.
just for listeners that haven't been exposed to that yet, give us an example of what you're describing as a synthetic bridge.
Yeah, so synthetic bridges, when you buy a bridge product, it's floating debt, and so normally what you do is you'd have to get a rate cap, and so when you do a rate cap, you're the one buying the rate cap, so you have the exposure. It's basically a forward contract. So um, your insurance policy is paying you back over, the spread, or 70% of the spread that this product's exposed to. Well, so if the lender prices that product into their interest rate, then they fix your rate to the term. So let's say we're doing a 3-year term, and um, it's a 3-year term, and there's the cost of the rate cap is, let's make up an example, 1.7 million. They can calculate what that is over 3 years and price that into your interest rates. So you're actually making interest payments towards it, but it's fixed. Your interest rate is fixed, which I think is, it's going to give this lender a lot of pipeline in the future. And there are banks that are, or groups that are doing fixed rate bridge products. A little bit pricey now, but it is balance sheet capital. So there's really no CLO market out there. So not a lot of securitization going on. So these guys are, they're really underwriting the deal thoroughly. It's not like they weren't in the past, but a lot of these lenders, they know who their end customer is, so they just like basically underwriting is to sell it at close. So this is staying on their balance sheet, so they've got to stick around for a year or two.
Yeah. Well, thanks for describing that. I appreciate it. I want to shift gears a little bit, and I want to talk about maybe do a little mini case study with you on one of your recent acquisitions. You took down a deal, a 295 unit core A-class new construction value add deal, which I'll allow you to just sort of describe what the value add component was, but a $63 million purchase in the Richland, Texas market, roughly $21 million of equity. So maybe if you can, let's just talk about how you sourced the deal and just describe the asset for us in general.
Yeah, so beautiful asset, anchored in a 134-acre retail development. So, it has the grocery stores, HEB, it has the Chick-fil-A's, the, fitness centers, everything you need within, a 2-minute drive. So you literally live where you shop, which is great. I love suburban pockets. I think that's another focus of ours, is to find those little niche pockets, because we're looking for convenience now. It's a different world where a lot of us have been afforded the ability to work from home. So moving into a nice new apartment complex with all the bells and whistles, with the shopping nearby, is kind of a no-brainer. So that's what we're focused on, those kind of deals. We've tried to take down a few of those, the vertical ones with the retail component down at the bottom, but that was during COVID time, and they weren't giving you credit for that. But I absolutely love it. because it's another source of income on your apartment. So, definitely something we'll look at in the future when core deals make more sense. But right now they don't. But so these where the value add exists in these types of transactions is, again, we've had a lot of push in a lot of tailwind action with our rent. So we're seeing, where the builders leased it up to
Mm,
issue those first rents to where the market is. There's a year one possibility of $140, $150, which, when you're talking, $61 million deal, that
hmm
it adds up on. And our focus, is protecting capital. An A-class building is going to be an A-class building, for the next 5 to 10 years. So, that cap rate's going to be an A-class cap rate. So that's one thing we've kind of looked at. It may not be the hugest IRR that you're going to get, but the value is going to be there, in the future. So let's say we have a soft economy for the next, I don't know, 4 years, 5 years. When we go to exit, hopefully those cap rates are back on the way down, and then it just becomes a math equation.
Yeah. And, getting into a deal like that, $21 million of equity, the newer operator, newer sponsor, in some cases may not be able to bite that off because you're limited by the amount of equity that you can raise. What was the source of the 21 million? Is that
Yeah.
strictly your investor network? Was it family offices? Was it, where do you find your equity?
So we did pretty well on one of our deals.
Mm,
We bought it at 6.8 million, sold it for 15.7.
not
Got
not a
a
bad
got a
return.
three, not a bad return, 3x on our LP capital, and a lot of them 1031 into this one.
Okay.
And then we just raised capital from our existing pool, and then we had a larger JV partner come in. So that's kind of how we solve that capital stack. We are in the process of focusing on that JV structure with some family office type, institutional type, really.
hmm
And so that's been kind of our focus here over the next, or my focus here over the next couple of months, is securing that programmatic relationship with an LP, and that way I can bring on 20% of the capital stack, from friends and family, and then also get more deals done. That's the name of the game is right now for us is we're pretty excited for next year. I think it's gonna be a painful year, but it's gonna be an opportunistic year.
Yeah. And how was this deal sourced? Richland, Texas. You're based in Atlanta. I think a lot of your focus has been in the general Atlanta market. How was this particular deal sourced?
No, so we're southeast. We're
Oh,
in
right.
Tampa,
Okay.
Atlanta, Nashville, we're in San Antonio. So we're all across the Sun Belt. We focus on all these markets, and really it fits our criteria with these tertiary, kind of new construction deals. And Texas has a lot of them.
hmm
There's a lot of growth going on, which we like, a lot of good quality jobs. And so we follow the population growth, and we follow the employment growth, frankly, because if you're going to relocate your headquarters, you're not going to do massive layoffs at headquarters. You're going to do it at locations
hmm
where it's not friendly for business. So um, we're going to expand in Texas, actually opening up our Dallas office here in the next 6 to 12 months, and then have a permanent presence in the kind of Texas area. The nice thing about being in Atlanta, it's a quick flight. Within two
Yeah.
hours I'm anywhere. So that's why
Yeah.
I strategically picked this hub.
Makes sense. And then as far as just for context, when did you purchase this asset?
So we're closed on that earlier this month.
Oh, okay, great. And can you walk us through the debt side of things and what that looked like?
So we have, this is one of those fixed rate bridge
Okay.
products where that it's really basically like a construction loan, right? Because we're still in lease up, and so You know, they hold a little interest reserve. Imagine back to the COVID days where they're like, oh, add an interest reserve just in case. So it's exactly the same thing which we've
Mm,
been through. And they just take their debt service from that. And, you know, as the property stabilizes to a 1-2, we go and we refinance them out.
mm, understood. And so what was the occupancy when you acquired, or what is it today? I mean, it's only
It's
earlier this month.
72% occupied.
72.
Yes.
Mm,
So yeah,
okay.
it's phenomenal lease up. When we started the process, we were about 20% occupied, and as they
Oof.
both completed, they moved the fence back, leased up, both completed, leased back, that kind of thing. So
Uh,
yeah,
So are you targeting, do you see yourself targeting this particular niche moving forward, this new construction, just starting lease up where you can come in and you can see a margin between what the builder has done and what you could do with the asset? Is that something that you see yourself targeting specifically moving forward?
we've been targeting that for the
Mm,
last 2 years, and we're actually developing two projects in Atlanta. So 180 unit townhome, built to rent community, and a 280 unit
mm,
apartment complex, 55 plus community. And so, you know, we're in that space. I would love, you know, my vision for the business is we're, you know, if we can do 1 to 2 construction deals a year, ground up, that'd be great. And then, you know, the existing lease up. So you take off the construction risk and you're taking on the lease up risk, which, let's be honest, in a recession, you know, folks are going to move, you know,
mhm.
to an apartment, and kind of, you know, that becomes more, we becoming more and more a renter nation in any case. So, you know, the market that we're focused on is, it's more of an affordable A class. It's not super luxury, $3 a square foot stuff. We're not doing that. We're doing, you know, $1.75, $2 square
Mhm.
foot, which I think is affordable for these days and age. And obviously, when you look at where the mortgage rate, um,
Right.
mortgage rates are today, and, you know, the average home price, like, we know it's coming down, but still, you know, this area in particular, houses are $1 million, 800,000. So, you know,
Right.
the average mortgage payment is well above what you could rent for. So we see, you know, opportunity, and location wise, again, in that urban pocket. So, you know, you'll have, you know, younger demographics, starting
Demographic.
family, that kind of thing.
Yeah.
Yeah. So focus
Understood.
on those kind of things. If I could do one construction deal a year, that'd be fun. You know, life. You know, I recently spent some time with I belong to a Vistage, this group called Vistage for CEOs, and, you know, we kind of sat back and we were like, you know, why did we start this business? What am I doing this for? And, you
Mm,
know, we get lost in the weeds, you know, as business owners and as entrepreneurs. You know, even if you're doing this stuff on the side, you just like focus. I've got to get there. I got to get there. But you're like, you forget about the fun. Like, why did I do this? Like, what, you know? So we're, you know, going back to like, what are some of the cool things that I wanted to do? Like build something, like really, you know, get creative, and you know, so we want to get to 50,000 units. But we want to have fun along the
yeah.
way, right?
Well, and
Yeah, I don't.
that development ground up piece allows you to sort of scratch that
Oh, itch.
creativity
Yeah,
itch. Yeah,
yeah,
understood.
100%.
Well, look, I've enjoyed our conversation thus far. I want to start winding down here. Just have a few final questions for you.
Sure.
The first is, considering where we're at in the market today, what's your prediction for the real estate market over the next 12 months?
So over the next 12 months, I think it's going to be slow and steady. I think, you know, we'll see some great opportunities in certain markets. I don't think it's widespread across the country. For us in the Sun Belt here, we've seen so much in migration that it's kind of annoying. But, you know, good for business. You know, and so I think slow and steady, with some, you know, more realistic corrections. I mean, but again, I don't have a crystal ball, so, you know, if it drops, don't, you know, don't blame me. But then it's opportunities, right? So we've got to be
Right.
opportunistic in those instances. But I think, you know, where we're investing, I think it's going to be fairly steady, and you know, kind of not business as usual, but business, you know, creative business will be going on.
Understood.
I think a lot of loan assumptions, maybe those kind of things. I think sellers will get more creative if they're in that exit phase.
If you were to start your business over from scratch today, you had to go to zero and you were starting back over today, what would you do?
I would do the same thing again. We would, you pick up the phone, dial brokers, establish those relationships, underwrite 1,000 deals before you find something, network. Yeah, I wouldn't do anything different.
Would you go immediately to the type of deals you're working on today?
Yeah, I would. Right now, I still think there's the deals in the CNBs are still very expensive.
Hmm,
But I think there will be an opportunity again.
sure.
I've seen some things, come past my desk, and I'm like, wow, that's interesting. It's
It
not a
makes you take
deal,
a
but it's
second look.
interesting.
Yeah.
Yes, exactly.
What has been the most challenging aspect of growing your business to the point that it is today?
People, the right people in the right seats. So if you've ever read the book Traction by Gino Wickman, EOS is we've self implemented EOS, and we're about to embark on having an implementer. Well, that they cost a little bit of money to have them
Right.
on, but they definitely worth it. And I think having the right people empowers you to have the peace of mind that your team behind you is able to execute. And it's been a very iffy labor market, and there's been challenges. You have younger folks joining the workforce, and it's just their work ethic is completely different to the
Mm.
older folks. So there's definitely something to that, and a lot of headaches and head scratching. So people have been a challenge.
What's the difference between you and many other aspiring sponsors, real estate sponsors out there in the world that may be struggling to grow their business? What is the difference between you and someone who is struggling to grow?
The difference is nothing. We all have blood, we breathe in air, we have muscles. I think the important thing is you've got to exercise those muscles. You need to have a goal, stick to it, make it measurable. I will never forget my business partner and I, my COO. We sat outside at a coffee shop, and we kind of wrote down and mapped out our vision, and we had no office at the time. We were just at a conference in Atlanta. At the time, we lived in Florida. Of fast forward 2 years, we're up in Atlanta with an office and 27 people, and all these kinds of things going on. And it really started with us taking it serious and writing down that goal and that vision, and then putting in the little pieces. Once you know where you want trying to get to, then it's really just executing on the little things that you have control over. So there ain't no difference. You just gotta, every day, piece by piece.
Love it. Love it. Well, look, this has been an excellent conversation. I appreciate you going into some detail about your background and how you got into space, what your business is focused on over the last 5 years, how you got to where you're at today, and what you're focusing on moving forward. Before I let you go, what's the best way for our listeners to connect with you and learn more about what you have going on?
Yeah, so we're on, social media. Our website is www.dreamstoneinvest.com. You can email us at info@dreamstoneinvest.com, and our team will take care of you. And I'm happy to share anything with your listeners, add value as we can. Happy to do that.
Awesome. Well, Vehano, thank you for coming on the show today. Thanks for sharing your journey with us. For those of you that are listening, if you enjoyed the conversation that we had today, go down into the show notes right now. Click on that link to connect with Dreamstone Invest and Vehano and his team. I appreciate you coming on. I enjoyed our conversation, and I look forward to staying in touch down the road.
Thank you. Appreciate it. Thank you, David.